And the problem is I've been so driven that I've driven over people, that I've used people to get money. And that's easy for me to do. And the only thing that I know that takes the wind out of the sails of greed is to give it away.
Welcome. This is the Hot Real Estate Investing Podcast, a podcast dedicated to helping others through real estate investing. Our hosts interview guests from all aspects of real estate investing who generously share valuable experiences and advice. Whether you're starting out or an experienced investor, this is the show for you.
Hello and how's it going? My name is Travis Shelton and welcome to the Hot Real Estate Investing Podcast, where we focus on the mindset, motivation, and methodologies of successful real estate investors. And we have a great guest with us today. He's managed over $300 million in assets and has over 10 years of real estate investing experience, including multifamily, RV parks, storage, short-term, and industrial properties. He's an author of The Giving Crisis, 9-Figure Wealth Manager, and Philanthropist. It's my honor to introduce to you all Andrew Mcnair, the president and founder of SWAN Capital. Welcome, Andrew.
I'm glad to be here.
Well, I told a little bit of the audience your background, but you definitely have a lot more. So maybe you mind sharing with the audience just maybe your 30-second elevator pitch, a little bit more about yourself and your real estate background?
Yeah, absolutely. My story starts like many people's does. My dad was the poor dad in Rich Dad, Poor Dad. He was rich in integrity, but not with a lot of financial acumen. No one really taught him. So I really related to the Rich Dad, Poor Dad book, and I started asking my parents a bunch of financial questions and real estate questions, and they were smart enough and sincere enough to say, we don't have the answers you're asking. And so I started interning at a financial firm at 14. And this Mr. Miyagi figure took me under his wing and he said, I'll teach you everything you need to know about finance, but you're going to have to fill out financial models. You're going to have to lick stamps for $0 an hour. And I thought that was the most incredible deal ever. And so after school every day, I would intern at this financial firm. And I realized, making $0 an hour, I'm never really going to get ahead financially. So I started waiting tables at Denny's. People order all those Grand Slams, and I was slinging Grand Slams at Denny's. I'd saved up $62,000 by the time I was 16, waiting tables from 14 to 16. Living under my parents' roof and grinding every weekend after school every day at the financial firm, not getting paid anything. And then 2008 happened. And it's so important. How you see the world and how you see money is probably dictated how you lived and your environment and the years that you were born and the years that you were working. And so when I saw people lose half their 401k, I thought this is the best time to go from being a saver to an investor. So I took my hard-earned life savings of $62,000 and I stuck it in the stock market, and it doubled to $142,000. So what I thought was, I have the Midas touch. I'm 18. I have it all figured out. Life is easy from here on out. And then the University of Hard Knocks called in the tuition payment. And you guessed it. It was $147,000. And that's why you'd find me at the age of 19 screaming into my pillow and punching my mattress with tears in my eyes, because I'd lost something so much greater than money that night. I lost time. All I could think about over and over was those weekends and the holidays. I couldn't get my money back, and I couldn't get my memories back because I never made them. I was working those holidays at Denny's and I could never get it back. And so right there, that's when SWAN Capital was born, understanding diversification, not wanting to lose retirees' assets. And then the other thing that was born that day was the Giving Crisis. Is I realized that I couldn't lose what I gave away, and I never wanted to lose anything ever again monetarily, and I never wanted to connect my net worth with my self-worth.
I love it. So much to unpack there, and I'm looking forward to kind of talking through it all. But we always start our podcast with some motivation, a motivational quote. Do you mind sharing with the audience the motivational quote you wanted to share?
Oh, that was so hard to pick a quote. I love Jim Rohn's quote, which says, we will all suffer pain, the pain of regret, or we're going to suffer the pain of discipline. And so I would tell others, choose the pain of discipline.
That's great. So tell us a little bit more. Why that quote, or why does that resonate so much with you?
That one always resonates with me because I sit down with families every day that have regret. I've sat across countless families already this year, that probably at least 5 or 10, that I had to say the following statement. Sadly, we invented this thing called retirement. It didn't exist hundreds of years ago. For thousands of years, people worked and then they died. And because of your situation, you're going to have to work a long time. And
Yeah.
that's the pain of regret. To say that to someone is hard to say it because it's the truth. Now, of course, we're going to equip them to try to get them on the right track. So maybe they can finally retire, take Social Security at age 70, and maybe have a small window of retirement where they don't have to work. But if someone would have met them 30, 40 years ago and shook them and said, I understand that you think you have more time, but you don't. And that to say, actually, it's going to be painful to save 20% of your money, long-term investments. It's going to be painful to put that 20% away. That's the pain of discipline. Yes, it hurts. And yes, it's painful to do, but you're going to enjoy that pain more than pain of regret.
Absolutely. I love it. You've spoken a lot of words that I use all the time. We talk on this podcast a lot about my poor dad. I love the grind. I love the hustle. I love kind of the rags to riches. So let's kind of dive right in of how can you help our audience of real estate investors? And maybe we start with first how and why real estate, right? Like you talked about stocks, you went from 16 to 18. What was that aha moment that you really thought, hey, real estate is the vehicle to kind of change my life?
Well, all of this is a true story. So every Sunday I drive to church. I see the duplex that I was at $142,000. I was going to buy this duplex in cash for $75,000. I knew based on my deferred maintenance checklist that at 18 I was going to be a owner of a duplex. I was going to fix this up. I was going to increase rents, and it was all going to work out. And today that property sold in 2022, I think for $270,000. So I would have collected rent this entire time from ages 18 to now 33. And I would have been able to sell it last year for $270,000 if I would have just been more diversified, practiced what I preach, which is diversification, owning investments and stocks, investments in real estate and stocks. I would have been far better off if I'd have done that. And sadly, I didn't. And that's why we help our clients every day choose true diversification between traditional asset classes in the stock market, fixed investments, and of course, real estate. I wish someone would have told me that.
So maybe we'll start off with, how do you explain to your clients why they should invest in real estate?
Yeah, I have clients that have only owned their own home. I have clients that are real estate moguls. And for the real estate moguls, they pick this up really quickly. I explain to them that you need to own real estate. You need to own passive real estate and active real estate. And people say, well, I read some books. Isn't all real estate passive? I say, well, the income is passive, but the work is not passive. Most times when you own real estate, it requires blood, sweat, and tears. And so when I picked up the pieces of my own personal finances and I started my own wealth management firm, SWAN Capital, I started having a lot of success. We were investing in our SWAN aggressive portfolio that we manage in-house. And I thought, my income is tied to the stock market. My investments are tied to the stock market. I need to start accumulating real estate. And so I started buying one house, 5 houses, 10 houses a year. And I got up to 54 houses, 136 apartments before I was 30. And I thought, I've already lost all my hair. I don't know if they're correlated, but I think if I get to 200 houses like my original goal, I'll be dead. This stress will kill me because real estate is not passive. It requires blood, sweat, and tears.
Absolutely. So what were some of maybe those trials and tribulations early on that as an active real estate investor, that you struggled with or caused you so much stress?
Oh man, where would you like to begin? So this is all true. Like, this is verifiable. I had someone burn my house down intentionally while I was finishing up the renovations. I had someone burn my house down accidentally. I had someone murdered inside my house, left for dead for 2 weeks. I had someone murdered in the front yard. That became front page news on the Channel 3 news. I had someone run their car into my apartment after I had just vinyl sided that duplex, and the insurance company didn't cover it because it was the girlfriend that drove it through the house, and it was my tenant's commercial truck insurance. And the insurance company said, well, she's not a tenant, so we're not covering anything. So if you live long enough, like my mother always said, it'll happen to you. So I have so many more stories to share.
Second, where do you invest so I don't invest there? Because these sounds like some pretty bad tenants.
Believe it or not, those were not even HUD properties. Like, those were like C level, D level properties, but not yet HUD.
Yeah. No, that's funny. I love the real estate stories. I think there could be just podcasts on all the terrible stories that all real estate investors have had. But maybe how did you kind of pick yourself up from maybe some of those early negative experiences? Why do you still invest in real estate? And how's your mind shift kind of changed now from those early experiences to kind of where you're at today, or have they?
Yeah, I mean, I still believe in owning active real estate. I think having a small portfolio is definitely a good idea because it gives you an appreciation for the numbers. It makes you run the ROI and the ROA and all the calculations that you need to do if you're investing in passive real estate or active real estate. But the reason why I built Signet, which is a baby swan, is that most of my clients, when they get into retirement, they don't have time to watch that egg hatch. They don't have time to run all of those numbers, to do the underwriting, to manage to handle the construction of it. And so that's how I've pivoted. Is I've sold all of those properties. I think I'm down to 6 houses now, and all my new money goes into Signet. You should eat your own cooking. You should be one of the biggest investors in your own investments. And my life is so much more peaceful because of it. Because yes, I might not get 20% rates of return like I did when I managed the properties, but if I can get close to a double-digit return or better, and no one's calling me and telling me that they pulled a ceiling fan on their head and now they're suing me, that's better.
For sure. For sure. Absolutely. Totally feel the same way. Definitely have some good horror stories of my own. And I both invest passively and actively, like you mentioned. So maybe why do you recommend that for your investors? Like, what are the big pros and cons, or maybe the pros? Let's focus on those at first.
Yeah, I mean, there's obviously tax advantages with real estate. That is a beautiful thing, especially if you're a high 6-figure income, low 7 figures. It's very important, of course, to have any tax depreciation deductions that you can add to your situation. The second is that it's a real asset. I call it real estate because it is a real asset, which is helpful in an inflationary period, which is what we find ourselves in right now, is dealing with inflation. I think the third thing that we all need to factor in is that it has asymmetrical risk. When you look at the stock market, it's all about cycles. Every good investment is going to have cycles that you can't predict perfectly, but there is pattern recognition. And we understand that real estate and the stock market have risk, but we need to layer in different investments like private equity and hedge funds and commodities and fixed investments and stocks, because those cycles blended together provide you that standardized income. It gives you that not variable income in retirement you're looking for, but that structured income in retirement that you're looking for.
No, absolutely. No, I appreciate you answering that and kind of describing. So let's talk maybe and pivot a little bit more into your actual current fund. What kind of fund do you currently have? What sort of assets do you place in that fund? Help our audience out a little bit with that scenario.
Yeah, again, I was invested in multifamily personally. So duplexes, triplexes, quadplexes. I was all
Mhm.
here on the Gulf Coast of Pensacola, a beautiful gem of America. And I thought, you know what, I'm going to do this differently. I'm going to build a fund that invests geographically diversified, Midwest, Southeast, as well as friendly West Coast states. And I'm going to invest in 4 different types of assets: industrial, short-term rentals, as well as storage units and apartment complexes. So I wanted to be diversified in that fund enough to provide our clients, because most of our clients are retired. They don't have a do-over. There's no mulligans, there's no redos on their retirement. And so we want to be very careful. As someone that's an RIA, a registered financial investment advisor, it's very important that I do proper due diligence. So we're very thorough of making sure we don't have too much with one operator, too much in one area, and too much in one type of real estate, to really give the clients the diversification that they could not get unless they had a 20 or $50 million net worth.
No, that's great. And I always discuss with people, people think about stocks and diversification all the time. And I think you brought up such a great point of diversifying within real estate, right? And it's something that I love, and I don't think enough people necessarily do. People I tend to fall in love with one asset class, right? You were doing multifamily, you love multifamily, everything in your fund, everything you do personally, professionally is in multifamily. So I really love the thought of saying, hey, maybe in some of my active real estate, I do multifamily. I maybe do a smidge in my fund at multifamily, but I also diversify in all these different areas. So help me with how have you built that investment company, and kind of how much in each asset class you're bringing into your assets under management each year, and maybe how are you finding some of these different operators to diversify, because it's easy to find maybe 1 or 2 good operators, right? But as like you said, as you're trying to diversify between multiple asset classes and maybe multiple operators, I find it maybe more difficult to be able to really get out there and network and find all these great, best in class operators out there.
Yeah, I mean, it's a needle in a haystack, and that's what our clients are hiring us to do.
Yeah.
Our firm brings in $100 million of new assets from clients, and we feel a lot of responsibility to, steward that and manage that for our clients. And so maybe 10 to 20% of that goes to Signet. So maybe $20 million a year. And with those, we're writing $1 million, $500,000 checks on the behalf of the Signet Fund. And we're doing a thorough due diligence. We're doing background checks. We're looking for vertically integrated operators that have a construction company, have property management in-house. And we're making sure that they have a long track record. I mean, I don't want to be their guinea pig. Someone else can be. We just don't have the luxury of being someone else's guinea pig. And so we're making sure that they have a track record, and that not only is that they have a business plan, but they've had the success of that business plan that closely aligns to their underwritten returns. And I think that's really important, because if someone says, well, look, we made 22% last year, well, that's fabulous. But if your business plan was 16, why is your business plan so far from what you actually made? We want to have those underwritten returns compared to the actual returns to be pretty close, unless something just really went your way. I think it's important to make sure that you do a thorough due diligence. Do not leave the retirement future of your family into someone else's hands. That just isn't prudent. And yes, of course, it requires more work. Of course, it requires more time to invest in multiple operators. But it's so important. We don't want to have more than 20% of our fund with one operator, even if that's invested over 15 or 10 different deals and 10 separate LLCs. It's just too much risk to put all of your money into one operator, in my personal humble opinion, especially when you're dealing with institutional money.
Oh, absolutely. I couldn't agree more. I think, back to the diversification point, and just, it's all your eggs in one basket as opposed to, spreading them out.
Yeah, I mean,
So
in
you
the
talked,
Egyptian
yeah,
hieroglyphics, they're cutting out a little symbol for diversification. It's age old for a reason.
for sure. Absolutely. I did not know that, but I'm going to have to look
No,
that up
I'm
because
just
I do
completely
love
joking. But there probably
oh
is.
man.
I mean, I can tell you in Ecclesiastes, which is thousands of years ago, Solomon was talking about diversification. That's a fact. So
Yep.
again, it's age old.
Yeah, no, 100% agree. So you talked a little bit about retirees, and so let's talk a little bit more about your avatar, your typical investor. Are you kind of is that your avatar looking for current retirees, or how do you find your current investors for your fund?
Yeah, we've built. I'd like to think that we've built a reputation, a trustworthy reputation here on the Gulf Coast,
Okay.
and that we're mostly a regional firm. I have clients all over the world now, that especially retired military that have moved to Japan and to Germany and to other places. But most of our clients is here. Probably about 90+% is here on the Gulf Coast. But I mean, the world's small. Being a millennial, I know how to do a Teams meeting in Zoom. So we're starting to get more and more clients, not only nationally, but internationally. And we really speak to that retiree. I mean, I named our firm SWAN Capital, Sleep Well at Night Capital. And so clients are looking for that.
Love
They're
it.
looking for someone and what's unique about our firm is they're looking for someone that has an estate planning attorney in office. We have a CPA in office. We handle our own portfolios in office, and we handle our own fund in office. So we don't outsource. We're not having some New York City yuppie managing your portfolio. Like, we manage that in house, and I put
Yeah.
1.8 million of my own money in Signet. And it's so important whenever you invest with a financial advisor, you invest with any firm. Most people do never ask, can I see your finances? Can I see your financial plan? And you have to realize, when you take advice from someone, you're trading places with someone. And if
Mhm.
how dare someone ask me all these financial probing questions like we do to clients, and them not be able to ask and turn the tables on me? So of course I have a financial plan. Of course I invest in our portfolios. Of course I invest in Signet, and I should, because that's what a good chef does.
Absolutely. I think it goes back to that. What's that saying? I think it's Warren Buffett. He says, Wall Street's the only place people go, drive there in a Lamborghini to take advice from someone that takes the subway or something along
Spot
those
on.
lines.
Rolls
And
Royce, to be exact. Yeah,
yeah,
you're exactly right.
and it's one of those things. I think the same thing. I think, who are you getting your money advice from? How well off are they? And when I
Right.
talk about investing in real estate, it's always, oh, this my uncle doesn't think I should. Well, how well off are they? I always ask those questions because they tend to not be the most successful people telling other people, it's more that shame of fear, you shouldn't be doing, you shouldn't do that. So
Or
I love
worse,
that.
most people are just giving advice from their one life
Yeah.
perspective. Like, I've lived 500 lifetimes like a vampire. I've seen what works and what doesn't. I've heard what worked for Joe at the water cooler doesn't work for everyone. And I could give you example over example where people say something and, like, maybe that did work out for your uncle, but it might not work out for you.
Yeah, I mean, definitely. And I just think everyone makes mistakes, but I think being able to your point earlier, you've lost your money, you made some mistakes along the way, but you never quit. You kept
Mm.
working, you kept grinding, you found success. And, a lot of times those early lessons are minimized because of how much money you can make from that lesson that you gleaned from that one little mistake. So I think too many people quit too early, and I love the fact that you kept grinding as well. I wanted to pivot real quickly because I love all the philanthropic, if I could talk, um, things that you and your company do. So tell us and our audience a little bit more about that. I told you my podcast is called Helping Others Through Real Estate Investing. As a pharmacist by training, I always have a component of my business that's charitable, that we're giving back, we're helping others. So that purpose, investing with purpose is really important to me and my business. So why did you give away $5 million? Let's start with that question.
Yeah, in my book, I teach people that an everyday philanthropist, by definition, a philanthropist is not someone that's some rich billionaire that gives. No, I mean, what a philanthropist is someone that gives a large percentage or gives a large amount of their income and assets. And so that's relative. And I believe everyone can be an everyday philanthropist. And that's why I teach others to do the same thing I've done, is take half our income every year and give it away, to take my net worth and give it away that I don't need. And the reason why is, if you're someone like me who can relate to this, as someone that's so ambitious and pushes hard, like, I struggle with greed. Like, greed is definitely my sin of choice, my poison poison. And I always will continue to push hard. And the problem is I've been so driven that I've driven over people, that I've used people to get money. And that's easy for me to do. And the only thing that I know that takes the wind out of the sails of greed is to give it away, because money does not have a hold over me when I keep my hands open. And I think this is why you're seeing an epidemic. This is why I call it the giving crisis in my book, is an epidemic of mental exhaustion, depression, and anxiety. And people do need to seek mental help. They do need to get medicated. But a lot of people, they just need a sense of purpose that's bigger than themselves. I mean, you were not made to live for yourself, not even for your family. You were made for something greater than you. And when you start giving towards that, your heart follows, because your heart's going to follow your money, or your money is going to follow your heart. And so I think they are very correlated. And so I want to lead sometimes my money, and I want sometimes my heart to lead my money, and back and forth towards the causes that I do care about. When I have a sound mind, I care about these egregious evils in the world, and I want to be a part of the end of those. And I think when you have something like that, or multiple things like that in your life, you're unstoppable. And even in your bad days, we all wake up with bad days. I know that I need to get up because someone needs me to get up. Someone that is less fortunate than me, someone that wasn't born in my zip code, and someone that wasn't born with all the advantages I have. And it's our job to use those advantages to leverage. And that's what ambition and is a healthy thing if it's just leveraged.
That's well said. And I guess you've been able to interview a lot of individuals yourself. And what's been like maybe the one thing, or the most common thing with all those individuals of, what sets them apart as far as giving? The Dabo Sweeneys and some of these bigger podcast guests that you've personally interviewed. What's maybe a commonality amongst them all, and how they give, or why they give?
Yeah, that's such a great question. We've had Larry the Cable Guy, and we're actually working on Manny Pacquiao as we speak, trying to nail down a date with him. And those three people just come to mind instantly. And I thought what they have in common, which many of them do, is that they started giving before they were ever wealthy. And many times we will say, when then I'll do it. When I'm super wealthy, I'll give. And I just want to say, yeah, I doubt it, because it gets a lot harder when the zeros start accumulating. Trust me, I know it was a lot easier to, tithe and give off my Denny's wages. And I'm glad I started, 10 and 20% back then, because, you start giving 50% of a big number, it's hard to let go of it. I mean, you want to, it's just human nature to try to protect. Like, I got to provide for my family. I got to provide for 5 generations of families. And I just encourage you to take the advice from many of those people that have come on my podcast, is you need to start now. You need to start giving now while it's easier, while the numbers are small. And I think if you do that, and as your income increases, you stop drawing new lines in the sand. And I see a lot of people do this. They'll say, when I make 100,000, I'll be happy. When I make $1 million, I'll be happy. And the good chance is you probably won't, because you didn't start giving when you had only 50,000 a year.
Absolutely. I couldn't agree more. I think it's one of those things that I felt better when I was poor and I gave money than when I gave money now that I have a little bit more money to give, right? I cared about that money a little bit more when I was 16 and 17 and giving money away to maybe the poor. And now maybe it's just easier to write a check with the extra zero behind it and not even really fill it. And, I try to not only give money, but also time. I think it's like we all say time is more precious than money. So me being able to go out there and give some of my time to some of these better causes really affects me more than maybe just writing a little bit bigger check than I'm able to now than I was able to when I was younger. But really love all that you're doing as far as, all your philanthropy work and being able to write these books and everything.
Well, thank you. I mean, I think it's the trifecta. I mean, the only thing you mentioned, we missed is, I would say we mentioned time. We mentioned treasure. but it's also talent. Like whatever your
Mm.
talent is, it's probably different than mine. And you can use those trifecta of time, talent, and treasure to do just marvelous work in your community and abroad. And there's people that need that three from you, not only your family, not only your job, but a greater cause that you feel, that you think about it. Maybe it's your church, maybe it's saving the whales. I don't know what it is, but if you take that trifecta and put it together, you got something magical for a worthy cause.
Love it. You've been a great guest for the Hot Real Estate Investing podcast, and all
Thank you.
focused on helping others. Maybe just bringing it back to real estate. What's your crystal ball this year? I mean, what do you see with the market? Are you getting a lot of investors that are more concerned this year, or are your investors starting to turn around and start thinking that there is maybe a little bit of light at the end of the tunnel and people are getting a little bit more optimistic about the real estate market?
Yeah, I mean, that's hard. So I believe real estate are longer cycles. I
Mm-hmm.
believe that you should be constantly investing no matter the cycle. I think that's long term. Trying to time the market is just foolish. I think it's timing
Absolutely.
in the market. Just the same thing we say with the stock market. It's the same as real estate. The real estate typically is, again, going to be longer cycles. And that's why it's so important to be diversified among different asset classes, because they definitely have different cycles in different periods of cycles. So what I'm telling clients on the stock market standpoint is you have two thermostats, is what I like to call them. You have the Shiller PE ratio, which is the PE ratio of the S&P 500 adjusted for inflation. The Shiller PE ratio is red hot at 34, 35. Every time it gets above 30 in history, nothing good has ever happened. The Great Depression, the dot-com crash, 2008, COVID, all of those happened after 30. Then the second is the Buffett indicator. If you take our national GDP compared to our S&P, our stock market, we're over one standard deviation. If it gets above 2, it's not. It's months, days till we have some sort of correction. Again, I'm not a market predictor here, but I'm just telling you that when those thermostats are red hot, the AC is going to come on eventually. And again, there's a correlation between stocks, the market, and real estate. They're not directly correlated. Again, asymmetrical risk, but you need to be mindful of all of these things that are starting to flash.
No, super helpful, and I appreciate you sharing your expertise with us. Well, we talked a little bit about thermostat now, so are you ready for the hot seat?
Whew, I hope so.
All right, we ask all our guests the same final 4 hot questions. So number 1, what is one book you'd recommend to someone wanting to know more about real estate investing?
Oh man, that's such a good question. Real estate investing. There's a book that is. I wish I was more prepared for that question, because it's a cash flow formulas. I always recommend that one. The best business book I probably hand out more of these than anything is The Road Less Stupid by Keith Cunningham. That is a great question for anyone in their own business, has a real estate business. That is the book you need to read. It teaches you how to think, which, as simple as that sound, is actually pretty profound, because most people don't think, they don't schedule time to think. And it gives you some of the questions to ask about your own business, to ask about your investments. Like, what am I not seeing? As simple as that is, that question right there could save someone hundreds of thousands of dollars.
Absolutely. Yeah. Sometimes it's the most simple question that can get you the most provocative answer or thinking. And I love it. Have not read that book, so I'm going to add it to my list. So I appreciate the recommendation. Question number 2, what's your favorite productivity tip, trick, tool, maybe an app that allows you to get more done than the average person?
It's one of those placebo things, but a lot of people talk about it on podcasts, and I was like, that's some voodoo. I don't believe in that. And then I bought it, and I was like, maybe it is really works. I have one of those chilly sleeps, one of the things that chills my bed down. And I bought one of those, the Uller. I have the brand, the Uller, and it chills down my bed to 69 degrees, and I sleep a lot better. I'm not throwing my leg out, throwing the sheets out. My wife is like an oven, and so I don't have to worry about it because it chills my bed to the right temperature. And what's cool is it has a setting that if I want to get up at 6:40 every morning, it'll turn it to 120 degrees. And if your bed gets 120 degrees, you'll never want to see it for another 12 hours at least.
Oh, I love it. That's a new one. I have not heard of that one. So I love the your questions, your answers so far. What's the biggest real estate mistake or failure you've made, and what did you learn from that experience?
Whew. You know, this one's just one of those that you have to sometimes learn the hard way is
Hmm.
you think you need to go cheap. Yeah, I got to go cheap. And that will cost you in the long run. Maybe
Every time.
some days taking shortcuts. Um, but I've went cheap many times, and those contractors, I've had many people steal my money. Many people that have done shoddy work that have had to fire. The person that burned my house down did shoddy work, wanted to be paid, yet work was not done. Burned my house to the ground while I was on vacation. So don't going cheap. I also tell people stop using family. Stop using family.
Mm.
I tell everyone that wants to to go into business, it's lazy to want to have your clients be your family. It's lazy to hire your family. Why did I say that? I know that's provocative because your systems are bad. And if you spent more time, you'd be able to create a better marketing system to attract non-family. And the fastest you can get to strangers, the better. And also the faster you can hire strangers, the better, because it builds out your processes within your organization. So stop hiring family. Just work extra hours and build your processes better.
Oh, great advice. All right, finally, if you could be remembered for one thing, what would it be?
I lived a year with my grandfather, and he grew up during the Great Depression. And he's one of the reasons I wrote The Giving Crisis, because it's true that during the Great Depression, we gave more during the Great Depression than we do today. So think about that. With 25+% with inflation, these are people that wanted to work, not people that didn't want to work. These were
Hmm.
hardworking people. 25% of them were unemployed in a soup line, and they gave more than the people do today. And oh, by the way, people try to excuse it, saying, well, the times are different. No, they didn't have double incomes. Actually, inflation on income has been outpaced. So income has actually outpaced inflation for most people, if you look that up. So there's a lot of reasons why they should have been less generous, but they were more generous than us. But on his tombstone, on my grandfather's tombstone, it says a good and faithful servant. And so I just want my life as a philanthropist to let money pass through my hands and not try to cup it with a thimble all the wealth. I would just want to pass through my hands, and I want to be poured out as much as I've been poured into. And I think that's truly living.
Oh, that's wonderful. I appreciate that answer, and it's definitely provocative and something that, I think great words to live by. And I love the story of the Great Depression. I had a grandfather obviously go through the Great Depression too, and the stories you hear, like you said, I mean, they were more giving, they were more loving, they were more helpful than probably any other time in the United States history. So we can learn a lot from our grandparents and the people that lived during the Great Depression. So thanks for that story. Um, the best place for the Hot RIA community to connect with Andrew, I'll be able to. I'll put all his information in our show notes: Facebook, Instagram, all your different social media outlets. So please connect with Andrew. Thank you so much for this interview. This was amazing. It was really great to meet you. We haven't really connected before, but I definitely hope to connect with you in the future. And maybe be able to raise or do some deals together in the future, Andrew. And to
Absolutely.
the audience, thank you for tuning in today, and commit to taking action today to move your investing forward. Take care, and God bless.
Thank you for listening to the Hot Real Estate Investing Podcast. Check out our website, hotrei.com, for additional content and resources. And please take a moment to subscribe and leave a review so we can continue to bring even more value to others through real estate investing.